Hello and welcome back to this course on IFRS 15. In this video, we are going to look at the 5-step model which is prescribed by IFRS 15. So in the 5-step model, the first step basically is to understand is there any contract with the customers. So the contract can be verbal, can be non-verbal, can be an arrangement, can be a practice. But there has to be a contract. There are certain specifications that the contract must meet that we will look into the details. In this video, we will look at all the 5 steps, and then in the coming videos, we will look at each and every step more closely, answering the questions such as the modification of the contract. What if there is a modification? So each contract which has been modified will be treated as a separate contract, and the revenue recognition need to change after each modification. Then the second step after you have identified the contract with your customer is that identify what is the performance obligation, separate performance obligations. In the contract, usually there are more than one services or goods which are being sold. For example, you are selling a car and the car comes with a 3-year warranty. Now, if the car generally we are selling only as a combined 3-year warranty, then it's the same obligation. But if we are saying that you have a choice, either buy a car, or you can say, okay, we don't want to buy a 3-year warranty, or you can buy a 3-year warranty separately, then there are two separate performance obligations here. So the car and the warranty itself. So these are two separate obligations. And let's say now we make it a bit more complicated. We say we will give you the car on installment. So you can you can take the car now by a deposit and make the payments in 5 different installments, 10 different installments by paying an X amount, right? So there is a third obligation on the installment. So we have to identify and understand what are the performance obligations, what are the promises, are they interrelated with each other or they are distinct, they can be served separately, or they have to be they are dependent on each other. So that also we will look at how we are going to identify that. After you have identified the separate performance obligation, we try to understand what is the transaction price. So the third step in this model is to understand what is the transaction price. Now the transaction price includes not only the fixed price of the contract, but also the variable part of the contract which is going to be calculated like a revenue share, like a percentage to the sales, depending on the sales, right? So that also will be considered as the transaction price. So how we are going to allocate that, we are going to discuss that in our coming videos. The fourth step is to allocate the transaction price. So the transaction price can be for combined price for all the performance obligations which is in the contract. So what the fourth step is to allocate the transaction price to separate performance obligations. Now, why do we do that? Because we in the IFRS 15 requires us to segment the revenue from which we are getting the revenue. So there may be the car sale, there may be warranty revenue, right, for example, and the interest income. So all three has to be identified separately. Give you another example. In hotels, when you are selling rooms, you are selling the food and beverage, you are selling the other services. But at most many of the time, these 3 services or 4 services are packaged together and sold as one price. So when you are disclosing your revenue by segment, the segmentation has to be correct, and the basis of that segmentation is the allocation of the transaction price into separate performance obligations. So we will look at that again in more details. So we have a process to allocate, but ideally the ideal principle behind the allocation is we try to understand the standalone selling prices of the performance obligations, and we look at if there is any discount, and we allocate that discount over to all the items so that we are distributing the revenue equally based on the standard price, standard selling prices. And then finally, we come to the last step as to when we have to recognize the revenue. And the recognized revenue will be based on the satisfaction of the PO. Now, the satisfaction of the PO can be at one single point or can be over a period of time. For example, the construction contracts, which can take maybe more than a year or more than 2 years to complete. So in that case, how we are going to recognize the revenue? The question comes is whether we recognize the revenue over a period of time or at one certain point of time. Now, this is also a very important consideration here, because when we are looking at the financial statements, if we make a mistake in recognizing the overtime revenue as on at the point time revenue, then the financial performance of the company will be overstated in one year and understated in the other years, and vice versa is the true as well. If you recognize a revenue which should be recognized in one point of time, uh, but you spread it out in the future years, then two things will happen. The cost is going to be recognized in that one year, so there's no matching principle, and also the revenue is understated in the first year and overstated in the future years. So that is also the principle has to be applied correctly. So that is the 5-step model.